Hello, it's Big Cheds. This is the Trading Encyclopedia Daily Education series on my YouTube at Cheds Trading. You can find me on Twitter at Big Cheds and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about regular divergence. You've heard the term a lot. What is it? It's essentially when an oscillator like the RSI, the on-balance volume, or the MACD is moving in the opposite direction of the price. These oscillators should confirm what the price is doing. They should confirm the trend. Let's take a look at this image, and in the top portion of it, we have the regular divergence. I have a separate video on hidden. You can look at that at a different time, but regular divergence in the classic sense, we'll look at strong, which is what most people think of. We'll look at these other variations in a minute. But for strong divergence, a bearish divergence, oftentimes you see people pointing out, look, this oscillator has a lower high while the price has a higher high. And we'll take a look at an example of that. Here's Bitcoin. This is back in March of 2023. Now, using the on-balance volume, which is an index indicator adding up the volume in the green versus the red candles, we're going to take the peak of this move and we'll notice, and again, we're drawing with candle body close to candle body close. Why? Oscillators calculate on candle body close. So the price makes a new high. It starts to close up here. And what we're noticing is that the on-balance volume is not confirming that. The on-balance volume actually made a lower high. And back at the image, this is a bearish divergence. Higher high in price, lower high in the oscillator. And why is that important? Well, essentially, as the price is advancing, you should see more green volume. It should be matching the trend. Right? When it doesn't match the trend, you want to look around. Now, you're not necessarily going to trigger just based on this. In this case, you could wait for something called, for example, an upthrust, where the price starts to break below the prior high. And then here you have the pullback to underside retest. It's what just puts you on watch. There's a little bit of weakness. I want to be careful. Now, you're drawing body to body. Here's a little trick. You can switch to the line chart. A line chart is just close, all closes. It's connecting the closes. It's going to make it a lot easier for you when you're trying to draw divergence. A lot of times people use the wick. They get it wrong. So here's a very classic example. Now, in the inverse, it would be a situation where if the oscillator, a bullish divergence, if the oscillator, the on-balance volume, for example, was making a higher low, and the price was making a lower low. I don't know that I have the example right here, but if the on-balance volume, again, was going higher, a higher low, and the price had a lower low, it would essentially tell you there's some accumulation and be on watch for a reversal, right? You want these oscillators to match what the price is doing. Now, as a quick note, I don't recommend using RSI for regular divergence. It's a bounded oscillator, has a fixed upper and lower limit. That means it gets stopped prematurely at the top, and you get these early divergences. You get it here with the RSI as well, but oftentimes the RSI will give you an early divergence, but it's also a hidden bullish divergence because it's cooling off and it's giving you more room to run. I generally wait for a double divergence with the RSI, where I might have two lower highs in the price, two lower highs in the RSI, and maybe two higher highs in the price. I generally like to use the on-balance volume. So that's just my recommendation for, I don't like using RSI. Now, there's some variations really quickly, medium and weak. So you can also have a situation, for example, the price has a flat high. So let's say rather than a higher high, and we'll stick with line chart, the price had a flat high, but you still had a lower high in the OBV. That would be a divergence, not as strong, but it's still a divergence, a medium divergence. And a weak divergence would be where if the on-balance volume had flat highs and the price had a higher high. It's still a divergence, just not as strong as the other two variations. Just in all of them, you really just want to see the oscillator matching what the price is doing. It should confirm it. And that's what you're looking for with divergence. Most important to remember is we're drawing divergence on candle body to candle body. And we are comparing highs to highs, lows to lows. We're not comparing highs to lows. And generally speaking, you want to use the RSI for hidden regular rather than regular divergence. There's some debate on that, but that would be my recommendation. Here you have it, regular divergence. And this is for the Trading Encyclopedia Daily Education series on my YouTube, Cheds Trading. Find me on Twitter at Big Cheds and Bitcoin Live, where I'm a founding analyst. Folks, thank you. I'll talk to you soon. Big Cheds out.